So now let's first look at fair value through net income method. As we just mentioned, the accounting treatment under the fair value through net income method is similar to the trading security method when we talk about debt investment. And specifically, the journal entries when we purchase the equity, this equity investment, we debit investment in the stock and credit cash. So because we're paying out cash and we're getting this stock investment. And when dividend is paid, so when we receive the dividend payment, we debit cash because we receive cash and we credit dividend revenue. And at the end of the financial reporting period, the change in fair value needs to be accounted for. So the journal entry here is if it is a loss, we debit unrealized holding loss, which is an income statement account. So it goes into net income and we credit fair value adjustment. And if it is a gain, we credit unrealized holding gain for net income. And when we sell this equity investment, we have two steps here. The first step is to adjust the investment to fair value. So if it is a loss, we debit unrealized holding loss for net income and credit fair value adjustment. And then in the second step, we record the sale and remove the investment. So the journal entries, we debit cash for whatever cash we receive. We credit investment in the stock and we debit fair value adjustment to remove all of the account which relate to this equity investment. So now let's look at an example. The example, company A purchased company B stock for 1.5 million. On December 31st, 2013, company B reported net income of 500,000 and distributed cash dividend of 750,000. The fair value of company B stock owned by company A was 1.45 million on December 31st, 2013. On January 10th, 2014, company A sold company stock B stock for 1.446 million. Its fair value at the date. So what are the journal entries to record purchase of the stock? Company A's share of company B's income, dividend revenue, fair value adjustment, and sale of stock under the two situations. The first situation is company A purchased 10% of company B stock. And the second situation is company A purchased 30% of company B stock. So if company A purchased 10% of company B stock, we need to use fair value method, a fair value through net income method. And if company A purchased 30% of company B stock, we need to use equity method. So let's first look at fair value through net income method. The purchase, please take 10 minutes, try to work on it on your own, and you can pause your video for now. So the first method, fair value through net income method. When we purchase the stock, we debit investment account, investment in company B stock account. The purchase price is 1.5 million. So we debit it for 1.5 million and we credit cash for 1.5 million. When company B reports net income of 500,000, under fair value through net income method, we don't need to do anything. And when company B paid out dividend of 750,000, under fair value through net income method, the journal entry is to debit cash because we get cash. And then here, the cash dividend is 750,000. And because company A owns 10% of company B, so we multiply it by 10%. So company A gets 75,000. And credit dividend revenue of 75,000. And at the end of the year, so we need to, under the fair value through net income method, we need to look at the fair value of the stock at the time and adjust the book value to fair value. So the fair value of the stock at the time is 1.45 million. And the book value at the time is, so the investment in company B stock was originally recorded at 1.5 million, and it was later nothing touched it. So it is still 1.5 million. So now fair value is smaller than the book value, which means that we need to mark book value down to fair value. And the difference here is 50,000. So we need to debit unrealized holding loss. So it is a loss here because book value is more than its fair value, which goes into net income for 50,000 and credit fair value adjustment for 50,000. And on January 10th, company A sold company B stock for 1.446 million. And then so the fair value now is 1.446 million. So we need to adjust this fair value. So which is book value of the stock at the time at January 10th to its new fair value. And the difference now is we need to adjust it down further by 4,000. So we first needs to mark the stock again to its fair value by debit unrealized holding loss, which goes into net income 4,000, and credit fair value adjustment 4,000. And then we need to move any related investment related account. So we get cash 1,446,000, and this account we have investment in company B stock for 1.5 million. And then another related account is fair value adjustment. So it was originally adjusted for 50,000, and then it was adjusted again for 4,000. So the total adjustment is 54,000. The balance is at the credit side. In order to reverse it, we need to debit fair value adjustment for 54,000. So those are all of the general entries if we're using fair value through net income method.